It rarely happens that someone who has seen decades of market cycles sounds genuinely alarmed, but this time feels different. When a veteran like Stanley Druckenmiller leans forward and says the Federal Reserve may have just made a fatal mistake, it's not a throwaway line, it's a signal. Not because he claims certainty, but because he recognizes patterns, and more importantly, when those patterns begin to break. Markets can tolerate tightening, they can even adapt to policy errors, but what they struggle with is a shift that comes too late, moves too fast, and ignores the underlying cracks already forming beneath the surface. And right now, that's exactly what appears to be unfolding. The timing of policy is everything, and in this case it wasn't just slightly off, it was meaningfully behind the curve. Inflation didn't suddenly appear, it built gradually, then accelerated in ways that were visible long before action was taken. Supply chains were tightening, fiscal stimulus had already flooded the system, and demand was running far hotter than the economy's capacity to absorb it. Yet the response remained slow, almost hesitant, shaped by a belief that inflation would prove temporary. That assumption became the foundation of delay that would later force far more aggressive moves. When central banks fall behind, they lose the luxury of precision. Instead of small, calculated adjustments, they're pushed into larger, more disruptive actions to regain credibility. That's where the real risk begins to form. Markets are forward-looking mechanisms, constantly pricing in expectations, and when policy lags reality, those expectations become unstable. Investors start questioning not just the direction of rates, but the judgment behind them. Confidence, once shaken, doesn't recover easily, and it tends to amplify every subsequent move. The initial hesitation created a gap between economic conditions and monetary policy. During that period, financial conditions remained relatively loose, even as inflation pressures intensified. Asset prices continued to reflect an environment of easy money, and leverage quietly expanded beneath the surface. By the time the shift in tone arrived, the system had already adapted to a completely different set of assumptions. Changing those assumptions abruptly is never smooth, because it forces a repricing not just of assets but of risk itself. What makes this particularly dangerous is the way delayed action compresses the policy timeline. Instead of spreading adjustments over a longer period, giving businesses and consumers time to adapt, everything gets packed into a shorter window. That compression increases volatility, not just in markets, but in the real economy. Companies that might have adjusted gradually are suddenly faced with higher borrowing costs all at once. Consumers who were comfortable with low rates are forced to reconsider spending decisions almost overnight. The shock isn't just financial, it's psychological. There's also a deeper issue at play, one that goes beyond timing. When a central bank signals that it misread inflation, it introduces uncertainty about what else might be misread. Policy is as much about expectations as it is about actions, and credibility is the anchor that keeps those expectations stable. Once that anchor starts to drift, even correct decisions can have unintended consequences because they're filtered through a lens of doubt. Markets don't just react to what is done. They react to how confident they feel about the people doing it. The delay also allowed imbalances to grow unchecked. In a low-rate environment, capital tends to flow more freely, often into areas that rely heavily on cheap financing. Those areas can expand rapidly, but they're also the most sensitive to tightening. By waiting too long, policy effectively encouraged the buildup of vulnerabilities that would later be exposed under pressure. When rates finally rise, it's not just a normalization, it's a stress test for everything that thrived under the previous conditions. Another consequence of being late is the loss of optionality. Acting early provides room to adjust, to pause, to evaluate how the economy responds. Acting late removes that flexibility. Once inflation entrenched, the focus shifts almost entirely to regaining control, even if it means accepting collateral damage. That trade-off becomes harder to manage, because the margin for error shrinks dramatically. Each decision carries more weight, and the cost of getting it wrong increases. There's a pattern that tends to repeat in these situations. Policymakers wait for clear evidence, then move decisively once that evidence becomes undeniable. But by the time it's undeniable, it's often too late for a gradual response. The cycle shifts from measured adjustments to reactive measures, and that transition is where instability tends to emerge. It's not just about the level of rates, but the speed and context in which they change. In this case, the late response didn't just set the stage for aggressive tightening, it reshaped the entire trajectory of the cycle. What could have been a controlled slowdown risks turning into something far more abrupt, simply because the early window for action was missed. And once that trajectory shifts, the pace of tightening stops being a policy choice and starts becoming a force of impact that ripples through every layer of the economy. What makes rapid rate hikes so unsettling is not merely their size, but the environment they collide with. On the surface, growth may still appear intact, employment numbers may hold up, and consumer spending might not immediately falter. But underneath, the structure is already softening, quietly losing years after years of dependence on cheap capital. Higher rates don't operate in isolation. They interact with existing fragilities. Businesses that expanded during periods of low borrowing costs suddenly find their margins under pressure. Debt that once felt manageable begins to feel restrictive as interest expenses climb. Refinancing, which used to be routine, becomes a challenge. And these pressures don't announce themselves all at once. They build gradually, then show up in unexpected places, often where leverage was least visible. For consumers, the shift is equally abrupt. Mortgages, credit cards, auto loans, each one responds differently, but they all move in the same direction. Monthly payments rise, discretionary income shrinks, and confidence begins to erode. It's not always dramatic. It adjusts subtly, then more decisively. Big purchases get delayed, smaller ones get reconsidered, and the cumulative effect starts to weigh on overall demand. What once felt like a strong and stable consumer base begins to lose momentum. Financial markets, meanwhile, are forced to recalibrate at a speed they're not always equipped to handle. Valuations that were built on the discount rates suddenly need to be re-evaluated. Growth stocks, speculative assets, and long-duration investments tend to feel the pressure first, but the impact rarely stays contained. As repricing spreads, correlations shift, and liquidity tightens and volatility increases. The adjustment becomes less about individual sectors and more about a systemic response to a changing cost of capital. What complicates matters further is the lag between policy actions and their full economic effect. Rate hikes don't hit immediately. They move through the system with delays that can span months, sometimes longer. When tightening happens rapidly, those lags overlap. The economy isn't just absorbing one increase, it's processing multiple layers of tightening simultaneously. That stacking effect can create a situation where the real impact isn't fully visible until it's already substantial. Banks and financial institutions also feel the strain in ways that aren't always obvious at first glance. Lending standards begin to tighten as risk perceptions change. Credit becomes less accessible, not just more expensive. This shift can be subtle in its early stages, but it has a powerful influence on economic activity. When access to credit contracts, it limits expansion, reduces investment, and amplifies the slowdown that higher rates are already initiating. There's also a psychological dimension that tends to be underestimated. Rapid changes in rates alter behavior, not just through financial constraints, but through perception. Businesses delaying hiring or scaling back plans for growth. Consumers adopt a more defensive posture, prioritizing savings over spending. Investors shift from seeking returns to preserving capital. These behavioral changes reinforce the tightening cycle, making its effects more pronounced than the raw numbers might suggest. The challenge with moving quickly is that it leaves little room to observe and adjust. Each rate hike is based on data that reflects past conditions, not current realities. By the time the data confirms a slowdown, policy may have already overshot. This creates a feedback loop where actions taken to control inflation risk intensifying the very weakness that follows. It's a delicate balance. and rapid tightening narrows the path even further. In an already weakening economy, this dynamic becomes especially fragile. Growth doesn't collapse all at once, it fades, then fractures. Certain sectors begin to contract while others hold on, creating a misleading sense of stability. But as the pressure from higher rates continues to build, those pockets of strength can erode quickly. What initially looked like resilience turns out to be delay. The real tension lies in the fact that policy is trying to address yesterday's problem while shaping tomorrow's outcome. Inflation demands action, but the economy's underlying condition determines how that action plays out. When the response is both delayed and accelerated, it increases the likelihood of unintended consequences, not because the goal is wrong, but because the path to achieving it has become compressed and unpredictable. That unpredictability becomes even more pronounced when liquidity begins to recede, because liquidity is the invisible force that supports nearly every market function. It's not just about how much money exists in the system, but how easily it moves, how confidently it's deployed, and how quickly it can absorb shocks. When liquidity is abundant, markets tend to forgive mistakes, smooth over volatility, and sustain valuations that might otherwise be questioned. But when it starts to drain, those same markets behave very differently, revealing vulnerabilities that were previously masked. The pace at which liquidity is being withdrawn matters just as much as the direction. A gradual reduction allows participants to adjust, reposition, and manage risk in an orderly way. But a faster withdrawal compresses that adjustment period, forcing decisions to be made under pressure. Capital that once flowed free-lective, then scarce. Funding costs rise, spreads widen, and the willingness to take on risk diminishes. This shift doesn't happen in isolation, it cascades through asset classes, affecting everything from equities to credit to emerging markets. One of the first signs of tightening liquidity is the change in market depth. Bid-ask spreads widen, price movements become more erratic, and even relatively small trades can move markets more than expected. This isn't necessarily a reflection of deteriorating fundamentals, but rather a sign that fewer participants are willing to provide liquidity at previous levels. When that willingness declines, price discovery becomes less efficient and volatility increases as a result. Leverage, which tends to build quietly during periods of easy money, becomes a focal point when liquidity contracts. Positions that were sustainable under favorable conditions suddenly require more collateral, more caution, or in some cases, rapid unwinding. Margin calls, forced selling, and deleveraging cycles can emerge, not because the underlying assets have fundamentally changed, but because the conditions supporting them have shifted. These dynamics can accelerate price movements in ways feel disproportionate to the initial trigger. The global nature of liquidity adds another layer of complexity. Capital doesn't respect borders, and changes in one major economy can ripple outward, influencing financial conditions elsewhere. As liquidity tightens, currencies can come under pressure, particularly in economies that rely on external funding. This can lead to a feedback loop where currency weakness forces further tightening, amplifying the strain on local markets. What begins as a domestic policy adjustment can evolve into a broader global recalibration. There's also a structural component to consider. Over time, market participants adapt to the presence of abundant liquidity, building strategies, products, and expectations around it. When that foundation begins to shift, the adjustment isn't just cyclical, it's structural. Business models that depended on cheap and accessible capital face new constraints. Investment strategies that thrived in a liquidity-rich environment may struggle to perform. The transition requires not just tactical changes, but a rethinking of assumptions that have become deeply ingrained. Central banks are aware of these dynamics, but managing them in real time is inherently difficult. Liquidity is not a single lever that can be adjusted with precision. It's the result of multiple interacting factors, including interest rates, balance sheet policies, and market sentiment. When these factors move simultaneously, the combined effect can be more powerful than anticipated. Efforts to control inflation by policy can inadvertently accelerate the withdrawal of liquidity, intensifying market stress. Another challenge lies in the uneven distribution of liquidity. Not all sectors or participants are affected equally. Larger institutions may have access to more stable funding sources, while smaller or more leveraged players feel the impact more acutely. This unevenness can create possibility that immediately visible in broad market indicators. Stress can build in specific areas, then spread as conditions worsen, catching markets off guard. As liquidity continues to decline, correlations between assets can shift in unexpected ways. Diversification, which relies on assets behaving differently under various conditions, can become less effective. In periods of stress, assets that were previously uncorrelated may start moving together, driven by the common factor of liquidity withdrawal. This can amplify losses and reduce the effectiveness of risk management strategies. The speed of this transition is what makes it particularly challenging. Markets can adapt to tighter conditions, but adaptation takes time, and time is precisely what becomes scarce when liquidity is drained rapidly. Participants are forced to adjust on the fly, often reacting rather than anticipating, which increases the likelihood of missteps and overreactions. The result is an environment where stability feels fragile and where even small disruptions can have outsized effects. That fragility is compounded by something far less visible but arguably more dangerous: the delayed impact of the tightening that has already been put in place. Monetary policy does not operate in real time. It moves with a lag that can obscure the true state of the economy. Decisions are made based on current data, but that data often reflects conditions from months earlier. By the time the effects of higher rates begin to fully surface, policy may have already moved several steps further, intensifying pressure that is only just beginning to be felt. This lag creates a false sense of control. Early in a tightening cycle, the economy can appear surprisingly resilient. Growth may slow only modestly, employment may remain stable, and inflation may not immediately respond. This apparent strength can be misleading, encouraging the belief that more tightening is both necessary and manageable. But beneath that surface, the transmission mechanisms are already in motion, quietly working their way through credit channels, balance sheets, and behavioral patterns. The housing market often provides one of the clearest examples of this delay. Rising interest rates do not instantly halt activity, but they gradually reduce affordability. Buyers take time to adjust, sellers take time to respond, and transactions slow before prices fully reflect the new reality. Construction projects that were initiated under different assumptions continue for a while, masking the slowdown. But eventually, the cumulative effect becomes evident, and when it does, it tends to be more pronounced because of the time it took to build. Corporate investment follows a similar pattern. Decisions about expansion, hiring, and capital expenditures are not reversed overnight. Companies operate on plans that were set in motion months in advance, often based on expectations that no longer hold. As financing costs rise and demand begins to soften, those plans are reassessed. Projects are delayed, budgets are trimmed, and hiring slows. These adjustments don't happen all at once. They unfold gradually, then gather momentum as conditions continue to tighten. Consumer behavior also reflects this lagged response. Households don't immediately change their spending habits with each rate increase. Savings accumulated during periods of economic strength can cushion the initial impact, allowing consumption to remain relatively stable. But as borrowing becomes more expensive and real incomes are squeezed, that cushion begins to erode. Spending shifts from discretionary to essential, and the broader economy starts to feel the difference. What makes this dynamic particularly challenging is that multiple rounds of tightening can overlap before the full effect of the first is even realized. Each rate hike adds another layer of pressure, but the economy processes them with a delay. This stacking effect can lead to a situation where the cumulative impact is far greater than anticipated. By the time the slowdown becomes clearly visible in the data, the forces driving it have already been set in motion, and reversing course becomes more complicated. There is also a tendency to rely heavily on backward-looking indicators, which can reinforce the risk of underwriting these lag effects. inflation data, employment figures, and growth metrics all provide valuable information, but they are snapshots of what has already occurred. They don't fully capture the pressures that are building beneath the surface. When policy decisions are based too heavily on these indicators, there is a risk of responding to yesterday's conditions while inadvertently shaping tomorrow's problems. Financial markets attempt to anticipate these lags, but they are not always accurate. Expectations can shift rapidly, influenced by new data, policy signals, and changes in sentiment. This creates a feedback loop where markets and policymakers are constantly reacting to each other, sometimes amplifying the underlying uncertainty. When the lagged effects begin to materialize, the adjustment can be swift and, at times, disorderly. Another layer of complexity comes from the uneven way these effects are distributed across the economy. Some sectors are more sensitive to interest rates and respond more quickly, while others take longer to adjust. This can create a fragmented picture, where parts of the economy show clear signs of strain, while others appear relatively unaffected. Interpreting this mixed signal becomes difficult, increasing the risk of misjudgment. The core issue is not just that the effects are delayed, but that they are difficult to measure in real time. Policymakers are effectively navigating with incomplete information, making decisions that will only reveal their full consequences later. In a rapidly changing environment, this uncertainty becomes more pronounced, raising the stakes of each move and narrowing the margin for error. And when that margin for error begins to narrow, markets start to sense it long before it is formally acknowledged. Risk is rarely repriced in a smooth, orderly fashion. It tends to shift in bursts, often triggered by a change in perception rather than a change in facts. The vulnerability of risk assets in this kind of environment lies not just in elevated valuations, but in the assumptions that supported those valuations, assumptions that are now being tested under far less forgiving conditions. For years, the backdrop of low interest rates and abundant liquidity created a framework where future earnings were heavily discounted at minimal cost. This allowed growth-oriented assets to command premium valuations, justified by expectations that extended far into the future. But as rates rise and liquidity recedes, that framework begins to break down. The cost of waiting for those future earnings increases, and the present value of distant cash flows declines. What once seemed reasonable starts to look stretched, and repricing becomes inevitable. The shift doesn't occur evenly. It often begins in the most speculative corners of the market, where valuations are the least anchored to current fundamentals. These areas tend to react quickly, sometimes violently, as sentiment changes. But the impact rarely stays contained. As losses accumulate, they influence broader risk appetite. Investors become more cautious, reassessing exposures across portfolios, and gradually extending that caution into more established asset classes. Credit markets play a critical role in this process. When conditions tighten, spreads begin to widen, reflecting an increased perception of risk. Companies that rely on borrowing to fund operations or expansion face higher costs and, in some cases, reduced access to capital altogether. This can create a feedback loop where financial stress leads to weaker performance, which in turn justifies the higher risk premium. The repricing of credit risk often precedes or accompanies shifts in equity markets, reinforcing the overall adjustment. Another factor that amplifies this vulnerability is positioning. During extended periods of favorable conditions, investors tend to build exposures that align with the prevailing trend. These positions can become crowded, not necessarily because they are irrational, but because they have been consistently rewarded. When the environment changes, those same positions can unwind rapidly as participants rush to reduce risk. The speed of this unwinding can exacerbate price movements, turning what might have been a gradual adjustment into a sharper correction. Liquidity, or the lack of it, becomes a critical constraint during these periods. As markets begin to reprice, the willingness to provide liquidity diminishes. Buyers become more selective, sellers become more urgent, and the gap between them widens. This dynamic can lead to sudden drops in prices, not because underlying values have changed dramatically, but because the mechanism for matching buyers and sellers has weakened. In such conditions, volatility becomes both a symptom and a driver of further instability. There is also a psychological threshold that, once crossed, can accelerate the process. Investors who were previously focused on maximizing returns shift their priority toward preserving capital. This change in mindset influences behavior across the board, from institutional portfolios to individual participants. Risk tolerance declines, time horizons shorten, and the willingness to hold through uncertainty diminishes. These shifts can reinforce downward pressure on asset prices. Even in the absence of new negative information, global linkages add another layer of complexity. Risk assets are interconnected, and stress in one region or sector can quickly transmit to others. Currency movements, capital flows, and changes in relative attractiveness all play a role in this transmission. As conditions tighten, capital tends to retreat toward perceived safety, leaving more vulnerable areas exposed. This relocation can amplify disparities and create pockets of acute stress within the broader system. What makes the situation particularly sensitive is the speed at which sentiment can change. Markets that once appeared stable can become volatile in a short period, as participants reassess not only the outlook, but the reliability of the assumptions that guided their decisions. In this context, even small surprises can have outsized effects because they occur against a backdrop of heightened uncertainty. The repricing of risk is not just a financial adjustment. It reflects a broader reassessment of confidence in the environment itself. When that confidence is shaken, it influences everything from investment decisions to economic behavior, creating a chain reaction that extends beyond markets into the real economy. That chain reaction becomes even more difficult to contain when policy itself remains inflexible, because rigidity in the face of changing conditions can turn pressure into something far more severe. Central banks operate within frameworks designed to maintain credibility, and consistency is often viewed as a strength. But when circumstances evolve rapidly, that same consistency can start to look like hesitation, or worse, an unwillingness to adapt. The risk is not just that policy stays tight for too long, but that it does so while the underlying economy is already bending under the weight of previous decisions. There's a fine line between commitment and stubbornness, and markets are quick to notice when that line is crossed. When policymakers signal a clear path and stick to it despite emerging signs of stress, it can create a disconnect between policy intentions and economic reality. That disconnect doesn't resolve itself quietly. Instead, it builds tension, as each new piece of data either reinforces the existing stance or challenges it in ways that demand a response. The danger of maintaining a rigid posture is that it limits the ability to respond dynamically. Economic conditions are not static. They shift in response to policy, external shocks, and internal imbalances. When policy fails to adjust alongside those shifts, it can amplify the very problems it is trying to solve. Tightening designed to control inflation can begin to suppress growth more than intended, and without a willingness to recalibrate, the cumulative effect can become increasingly difficult to manage. One of the most significant consequences of this rigidity is its impact on expectations. Forward guidance is meant to provide clarity, to anchor market behavior and reduce uncertainty. But when that guidance becomes too fixed, it can lose its effectiveness. Markets begin to question whether policymakers are responding to new information or simply adhering to a predetermined course. This uncertainty can undermine the very confidence that forward guidance is supposed to create. Businesses, in particular, are sensitive to these signals. Investment decisions rely heavily on expectations about future conditions, including interest rates, demand, and access to capital. When policy appears flexible, it introduces an additional layer of risk. Companies may delay or scale back plans, not because conditions have deteriorated significantly, but because the path forward feels less predictable. This hesitation can slow economic activity, reinforcing the effects of tightening. Consumers respond in a similar way, though often more subtly. Confidence is influenced not just by current financial conditions, but by perceptions of stability and direction. When policy appears rigid and merging challenges, it can create a sense that risks are increasing. This perception can lead to more cautious behavior, reducing spending and increasing savings, which in turn dampens demand. Financial markets act as the transmission mechanism for these shifts, translating policy signals into price movements and capital flows. When rigidity is perceived, markets may begin to anticipate a sharper slowdown or even a policy reversal at a later stage. This anticipation can lead to increased volatility as participants adjust positions based on expectations that are themselves uncertain. The result is an environment where policy intentions and market reactions are no longer aligned. Another layer of complexity arises from the interaction between domestic policy and global conditions. Central banks do not operate in isolation, and rigid policies in one major economy can have spillover effects elsewhere. As conditions tighten, capital flows can shift rapidly, affecting exchange rates, funding costs, and financial stability in other regions. These global feedback loops can amplify the impact of domestic decisions, making the consequences of rigidity more far-reaching than initially anticipated. The longer policy remains inflexible, the greater the risk that adjustments, when they finally come, will need to be more abrupt. Gradual changes allow for smoother transitions, giving markets and the economy time to adapt. But when adjustments are delayed, they often need to be larger to achieve the same effect. This can create a cycle where policy shifts from one extreme to another, increasing volatility and reducing the effectiveness of each move. At its core, the issue is not simply about whether policy is tight or loose, but about how responsive it is to evolving conditions. Flexibility allows for course correction, for the incorporation of new information, and for the management of unintended consequences. Without it, policy can become a source of instability rather than a tool for maintaining it. As pressures build and signals become more mixed, the cost of maintaining a rigid stance continues to rise, narrowing the range of outcomes and increasing the likelihood that a manageable slowdown transitions into something far more disruptive.